Like all financial markets, real estate cycles through a series of patterns of ups and downs. Now, nobody can forecast exactly how long a market cycle will go for, but understanding the predictable patterns within the cycle allows investors to make more informed decisions when in deciding how to invest at a given time. I've been investing for over 2 decades now, and I've successfully navigated through several full market cycles, including the Great Recession in 2008. So make sure to stay tuned, because in today's video, I explain the real estate market cycle and what it means for real estate investors. The real estate market cycle consists of 4 stages: recovery, expansion, hypersupply, and recession. Let's take a moment to break down each of these phases. So first, let's talk about the recovery phase. So now, what that is coming off of is we've just come through a recession, and it's hard to often recognize the recovery phase as to actually when it's beginning. What I mean by that is, in the recession, you've got an excess of supply, demand falls, oftentimes prices are falling as it relates to overall real estate investments. And then you begin to see that there is a bottom forming, meaning that, all right, people start transacting, transactions start increasing. We begin to see some overall general recovery in the economy. This is a moment in time where, again, you can truly, once you've seen that we've ended the recession period and we've begun to move into a recovery phase, you can really invest strategically, opportunistically, and I would say a bit aggressively. What I mean by that is that you're able to seek out opportunities, right? Properties where they have declined because of either lack of quality operations, difficulties that they went through the recession, maybe difficulties of the structure of their debt during that period of time, or during the time we've seen of interest rate increasing environment. Now you have these opportunities that come onto the scene. You can begin to move into them a bit more aggressively. Now, again, that still is a time where psychologically it's difficult for people to invest, right? You've just come through this recession or downturn period. People are still a little bit what I would call battered from dealing with those things. And the reality is, this is a great moment in time to begin investing, and even investing a bit aggressively, because you've come from this recession decline to a base or a stabilization, and then you're beginning to move into a recovery time. And often people are still kind of reeling, if you will, meaning emotionally. And again, we want to try to get as much emotion out of it as we can, but that unfortunately doesn't happen. We're human beings. And so this recovery phase presents a great opportunity to really begin investing. The next phase that we want to talk about is the expansion phase. Now, this is where we begin to see the economy starts to be picking up. There's an increase in demand for overall housing as well as buyers. And this really becomes something that you've come through the recession, you've found a bottom in this recovery phase, and now expansion starts to take place and it becomes demonstrable and you're able to see it. This really becomes where you start seeing a bit more of aggressive investing. Now, again, if you go back into 2008 and 9, quite frankly, people were still reeling from the effects of that downturn in 8 and 9. And so when you started to see expansion happening basically in 10, 11, and 12, there was still people that were reserved because of what they experienced before. The expansion phase, again, you don't want to ever become overly aggressive. Now, that happens to people, but you don't want to do it. But this now becomes the opportunity where you can begin moving forward in being very focused on acquiring more assets during this period of time. You still want to have good quality selection, but again, that opportunistic element is going to be diminishing more quickly, meaning more people are going to be coming in to the expansion phase. So it would be advisable to, as best as you can financially and with systems and people, be able to expand during that expansion phase, because this is a great opportunity to begin acquiring properties at what would be a good value during a phase where you're going to experience good growth. Next, let's talk about hyper supply phase. And so this is where the market has been hot, hot, hot. So we've had the expansion phase and it really cranks up. And then there begins to be a shift or a turning point where the supply starts exceeding demand. And you begin to see this because, again, the pricing has gone up, the demand has been there, it's almost been insatiable. You know, we saw that a lot here in 2021. We came out of COVID, and I mean, the market just shot up and people were just going, paying like it's a never-ending thing. But again, it always is an ending thing, right? And when you hear and see that it's a never-ending thing, know that you're close to it becoming an ending thing. And so we saw in 2021 that turn started to happen where, you know, and again, market forces with interest rate movement and inflation began to affect that. That uncertainty began to kick in, where then now there's beginning to be more deals available for sale than there are buyers looking at those properties, okay? And so that's a critical component of what you want to be able to understand. So, you know, how you would approach investing at this moment in time is definitely very critical, because you don't want to be, you know, buying a property at a certain market value only to see that value decline a bit. And so you have to recognize where you're at. And so right at this point in time, it's absolutely critical that you're not overpaying and that you need to be underwriting your acquisition very correctly, because again, you're entering into a phase where there's a likelihood of price declines. And so as you underwrite, you need to make sure that you're not making assumptions forecasting in the future, that you're still in this expansion phase. The likelihood is you're going to be buying at this point here, and there could be a short-term or a temporary, depending on where we're at, decline in price. And so depending on your hold period, if you're looking at a 5-year hold period, you've got some window there for the potential of what would be likely a recession and recovery. But again, you need to make sure that you're very focused on your price point for entry, because again, this is where we saw still people in the transition of 21 into 22 still paying expansion prices for properties in a supply environment. And those are properties that they're going to struggle with trying to execute on a sale, whether it's 23 or 24. Fourth, we move into the recession phase. This is where we've got an economic downturn. There's a slower rent growth happening. There's more distressed properties coming on the scene. Here in 2023, you know, we've seen the interest rate rise environment that's also affected the slowdown in the economy. We've also seen that it's affected properties as well. And then we would also look ahead in 2024 to see that there's an economic recession that's coming. And so during this type of time period, you can invest, and it becomes an opportunity for distressed properties that come into the market. However, again, you've got to be very clear and wary of not catching a falling knife. What I mean by that is during this period of time, you may have property prices coming into the market where prices are declining, and you know, you don't want to buy something at 100 a door only to see that that's moved down to 92 a door, because you know that's going to affect you. Now, I say that, but yet at the same time, you have to look at it deal by deal. You may be able to acquire a great property in a fantastic location that used to be 120 a door. Now you're able to get it for 97 a door, and it is in a phenomenal location. You're getting it at a cheaper price than what it could be built by. And so, you know, that's one where you could actually move forward and get, because it's a premier location. And even if pricing still moderates down to 92, you're going to be in a good spot because you're able to continue to move forward with your plan and driving rents. But during this period of time, you have to be very cautious about what you're purchasing and buying. So the recession phase is critical because you need to be certain that when you're making an investment execution, that you're getting it at the right price, that you're not going to continue to see deterioration. So again, this is a time that's absolutely critical. I would recommend for the new person, you really want to be with a seasoned partner as it relates to this moment in time. Let's talk about some of the general factors that can impact the real estate cycle. What we've seen in the most recent moment is interest rates, right? We saw inflation that really went up. And now there's part of a tie-in that we'll talk about government policies, right? The government policies after COVID to really flood the economy with, stimulus money. That affected all this free money. The other reality of government policies, keeping interest rates at near zero for, good Lord, a long time, almost a decade, affects the pushing up of values. But so now we saw inflation hitting strongly because of some of these things and the reality of the coming off of COVID. And then as a result of that, interest rates rising up. And as interest rates have risen, that has constricted elements of the economy. That's traditional, that affects real estate values. And then again, as interest rates have risen, that affects the value of real estate. It affects the demand for real estate because of the affordability. And so now also some of the areas demographically can affect areas of submarkets or markets of the real estate. And again, real estate is market specific. You can't just say all of the U.S. You have to look at different segments because demographically, the areas in some of the Southeast where we invest are still continuing to see job growth and demographic growth, where certain other areas, maybe in the North or Northeast, or less politically favored or business climate favored, those demographic areas are moving away from those areas. And so that's beginning to affect negatively the demand for real estate in those areas in terms of rentals and things of that nature. So another element that you see that affects the overall macroeconomy and real estate cycles is consumer confidence, right? Because again, consumer spending is about 2/3 of our GDP, and that really has an effect on the macroeconomy. So the more that consumers are confident, the more they spend, the more that they start to become uncertain about what's going on in the economy, the more they begin to pull back. And as they pull back, there's less money that's flowing, and that affects the impact on the different real estate cycles as well. So it's critical as an investor, or as a seasoned investor, is what I would say more particularly, about knowing what's going on in the real estate cycles. Right now we're in this hypersupply moving into recession period. As a result of understanding that and understanding what effects interest rates have had and where we are presently and where we're going to over the next probably 6 months, our firm has, continued to underwrite and look at properties, but we have not bought a property since August of 2022. That's like a year and a half. But the reason for it is we have conservative underwriting. We understand what's going on in the marketplace, and we are a protector or a shepherd of our capital and our investor partners' capital. And so we always want to be making wise, intelligent, and smart decisions so that we can first protect that capital and then secondly, maximize the return at the lowest risk possible. Well, hey, this has been fantastic talking about this, but one of the things I would be doing a disservice if I didn't really discuss some of the other realities in the marketplace. And unfortunately, some of the less seasoned investors out there had come into the market of commercial real estate, and maybe they came in the market in 15, 16, 17, something along those lines, but their investment cycle experience had only been during an expansion period. They didn't know some of the things that we're talking about here today, or they didn't pay attention to them. And the unfortunate reality of that is that they bought without understanding where they were at in the market cycle. Maybe it was 2021 or 2020. And then as a result of that, unfortunately, as they move forward through this next cycle where we enter into a recessionary period and they have to sell their property, they're going to experience a loss for them and or their investors. And that's an unfortunate reality, but it also is something that I have to make sure that you're aware of, that you want to be making sure, especially in this important time that we're in, that you're investing with people who are full cycle investors. What I mean by that is they've been through the market ups and downs. They've seen the good, the bad, the ugly that comes along with investing, and that they've navigated through it so that they can properly shepherd themselves and you through the market conditions that we're in. Well, that's all I have for you today. If you're interested in investing in multifamily real estate with me, click on the link in the description of this video to join our investor club and get early access to multifamily investment opportunities. Thanks for watching. Make sure to like this video and subscribe to my channel for more content on real estate investing. We'll see you in the next video.